What if your investment portfolio could do more than survive a recession? What if it could actually thrive? In most cases, when markets crash and uncertainty rises, most people panic. But here's the truth. You don't have to be a helpless passenger. With the right strategy, you can build a recession-proof portfolio designed to protect your wealth and generate income, even when the economy is struggling. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Recessions test your mindset, but they also offer once-in-a-decade chances to reposition your portfolio for lasting wealth. That's why the ultra-wealthy love downturns. They don't just survive them, they build empires in them. In this video, I will show you 5 powerful ETFs that can protect your portfolio, pay you consistent income, and help you sleep at night, even when the economy is in chaos. These are recession-resistant ETFs backed by historical data, strong fundamentals, and built-in cash flow. Whether you're a long-term investor or just starting out, this video will give you a clear, actionable game plan to build a fortress around your wealth. So if you want to earn passive income even during a downturn, own assets that historically go up when markets fall, or simply want to avoid panic selling and build confidence in any market, this video is for you. These ETFs aren't just smart, they're essential. And by the end of this video, you'll know exactly how to build a diversified, recession-proof portfolio that works for you, not against you. Welcome to Trailblazers Mindset, where wealth builders come to get inspired. Let's dive in. Number 1. Gold ETFs, IAU, the ultimate safe haven asset. When markets tumble and uncertainty takes over, gold has consistently proven itself as one of the most reliable safe haven assets. And iShares Gold Trust, IAU, makes owning gold easier than ever. Gold has been a timeless store of value for centuries, offering protection when paper assets lose ground. In times of crisis, investors often turn to gold to preserve their wealth, and history supports this strategy. Take the 2008 financial crisis, for example. While the S&P 500 plunged over 40%, gold prices surged by more than 25%. That's not just preservation, it's growth during collapse. Fast forward to 2020, amid the chaos of the COVID-19 pandemic, and gold once again demonstrated its resilience. Even as markets spiraled in panic, gold remained firm, proving its worth as a portfolio stabilizer. This ETF is my top pick for 2 specific reasons. Firstly, it offers an expense ratio of 0.09%, which is one of the lowest in the gold ETF category, and it also gives investors direct exposure to physical gold prices without the hassle of buying, storing, or securing gold bars or coins. This ETF offers a simple, cost-effective way to diversify and protect your portfolio. Unlike stocks, gold doesn't generate income through dividends, but in a downturn, it can be your financial shield. Think of it as insurance, not flashy, but invaluable when things go south. When markets are booming, gold may sit quietly, but when turmoil strikes, it shines, literally and financially. That's why IAU remains a foundational part of a smart investor's defensive strategy. It's not about chasing returns, it's about securing what you've already built. Before we dive into number 2, if you find value in this video, please hit the subscribe button to join our growing community. We appreciate your support. Thank you. Number 2. Dividend Value, SCHD. When the economy stumbles and markets turn turbulent, consistent income becomes more valuable than ever. That's where SCHD, Schwab US Dividend Equity ETF, steps in, a true recession-proof performer. In times when growth stocks falter and capital gains dry up, SCHD delivers one thing investors crave most: steady, reliable cash flow. With a 4% dividend yield paid quarterly, SCHD doesn't just preserve your wealth, it actively pays you to stay invested. Over the past 5 years, it has returned an impressive 17% annually, proving that value and income don't have to come at the cost of growth. Its ultra-low 0.06% expense ratio ensures more of your money stays in your pocket. SCHD holds some of the most durable companies in the market, such as Coca-Cola, Johnson & Johnson, and PepsiCo. These are industry titans with proven resilience in downturns. These businesses generate dependable earnings even when consumers cut back, and they've built reputations for maintaining and growing dividends year after year. Number 3. Balanced ETFs, ALLW, Ray Dalio's all-weather portfolio. In a world of economic uncertainty, few strategies have stood the test of time like Ray Dalio's all-weather portfolio. Designed by one of the most respected hedge fund managers in history, this strategy is built for resilience across every market condition: booms, busts, inflation, deflation, and everything in between. The IMGP DBI Managed Futures Strategy ETF, ALLW, captures the essence of Dalio's philosophy in a single, easy-to-own ETF. What makes ALLW so powerful is its strategic asset allocation. 30% in stocks for long-term growth, 55% in bonds to provide stability and income, and 15% in gold and commodities to guard against inflation and currency devaluation. This mix ensures that no matter what the economy throws at you, recession, stagflation, or rising interest rates, part of your portfolio is built to thrive. That's the genius behind the all-weather concept. Diversification not just by asset class but by economic scenario. While the expense ratio of 0.85% is higher than plain vanilla ETFs, you're paying for a dynamic strategy that actively adjusts exposures using managed futures to align with changing market conditions. It's like having a professional team constantly tweaking your allocation so you don't have to guess what's coming next. Number 4. Short-term bond ETFs. VBIL. In turbulent markets, safety becomes the priority, and Vanguard Intermediate Term Bond ETF, VBIL, delivers just that. When recession fears rise and stocks become volatile, short to intermediate term bonds offer a reliable haven. VBIL stands out as a smart, balanced choice that provides both stability and income, making it a cornerstone for conservative investors and those looking to protect their portfolios during downturns. VBIL offers a 4.2% yield, paid out as regular interest income, perfect for those who want passive cash flow even when equity markets are shaky. With an ultra-low 0.07% expense ratio, this ETF keeps costs minimal while providing access to a diversified portfolio of U.S. Treasury bonds and investment-grade corporate debt. These are among the most creditworthy and dependable securities available, backed by the U.S. government or financially sound corporation. Historically, during recessions, money flows into bonds, driving their prices higher. While stocks may plummet, high-quality bonds like those in VBIL often hold their ground, or even rise in value while continuing to pay you consistent interest. If you want peace of mind during uncertain times, this ETF belongs in your portfolio. Number 5. Consumer Staples ETFs, VDC. In a recession, spending habits change, but only to a point. No matter how tight the economy gets, people still buy the basics: toothpaste, soap, groceries, and household supplies. That's why consumer staples are considered one of the most recession-resistant sectors in the market. And Vanguard Consumer Staples, ETF, VDC, gives you direct access to the strongest companies in this space. VDC is built around industry titans with bulletproof business models, including Walmart, Procter & Gamble, Coca-Cola, and PepsiCo. These are brands people trust and rely on every day, regardless of market conditions. Even when consumers cut back on luxuries, they still purchase life's essentials, which helps these companies maintain steady revenues and profits through any economic cycle. With a 2.4% dividend yield and an ultra-low 0.09% expense ratio, VDC offers both income and efficiency. During market downturns, consumer staples tend to outperform more volatile sectors like tech or discretionary goods. Their consistent demand means stable cash flows, which in turn lead to reliable dividends, something every investor appreciates during uncertain times. The bottom line is that if you want part of your portfolio to stay grounded, even when the rest of the market feels shaky, VDC is a smart, steady choice. As we wrap up, remember that recessions are unpredictable, but your strategy doesn't have to be. The key to thriving in uncertain times is preparation, not panic. You're not just surviving the storm, you're positioning your portfolio to withstand and grow through it. So don't invest without a recession-proof plan. If you're ready to break free from financial limits, embrace online income, and start building real wealth in 2025, you're in the right place. Drop your questions or your own income journey in the comments. Don't forget to subscribe for more proven strategies on how to earn money online, build passive income, and create the future you deserve. Your support helps us continue to create content that empowers you to explore new income opportunities. If you are interested in strategies that can help you transform your dreams into success in 2025, check out our video on that topic. It covers 5 proven strategies. The link is in the description. Please note that we are not financial advisors. This information is for educational purposes only. We'll see you back here next time, Trailblazers. Until then, take care and thank you. See you at the top.